Hello, everyone, and welcome to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in financial markets for this week and beyond. Today is Tuesday, April 12th. I'm Mike Bernick, and joining me today are Mike Larson, Boris Schlossberg, Kathy Lean, David Dukevich, and Mandeep Rai. All right, good morning, everyone. Let's go ahead and get started with this morning's Squawk Call. Well, we've seen certainly a lot of volatility re-entering the stock market here last week, where the S&P and the Dow swung about 1.5% per day on alternating days, first up, then down, then up, then down. So we're certainly starting to see some turbulence again as a couple of market-moving events approach. First earnings season, of course, begins this week. Then next week on the 21st, we have the next ECB policy meeting, followed by the Fed just 1 week later. And speaking of the ECB in Europe, news out actually this morning, last night, that the Italian authorities in banks there actually cobbled together I think it was around a $6 billion bailout fund for troubled Italian banks, which is interesting to note. Good news coming here, 8 years after the financial crisis is supposedly over and the Italy's banks are still in trouble. So, Mike Larson, why don't you comment on that and take us from there?
Hey, sure. Good morning, everybody. As you mentioned, Goldman Sachs is the latest bank. Well, we got Goldman Sachs in the banking settlement, and we've got the European banks over there that can't seem to figure out how to stay in business without government help. And you add it all up, and it's just yet another reason why these financial stocks have been doggy all year. They were doggy last year. The European stocks have been particularly ugly in terms of performance, and nothing really seems to suggest to me that that's going away. Goldman paid or agreed to a $5.1 billion settlement yesterday with the government for crap that it did back during the mortgage crisis, almost 9 years ago or whatever, 9 or 10 years ago, which shows how long the sort of hangover from that process has been. And as we're still dealing with the hangover from that disaster here in the U.S., you're dealing with fresh problems over in Europe almost every day. I mean, the Italian banks are the worst of the lot over there in terms of their bad loans on their books, their inability to raise capital, their incredibly shrinking stock prices. We've seen that, even with some of the larger banks outside of Italy. I mean, Santander in Spain and Deutsche Bank in Germany and Credit Suisse in Switzerland and on and on. I mean, all of these stocks have been terrible performers over the last couple of years. And, part of the problem really goes back to what central banks are doing. The central banks claim what they're doing is helping, but, these negative interest rates and their other policies, they're not doing squat for the real economy. They're not improving inflation sentiment for more than a brief period of time, and they're also crushing the banking system by basically crushing margins. So, the transmission mechanism through to the real economy from all this easy money really isn't there, especially this late in the credit cycle. And, that brings me back to what I've been long and what I've been short. In the last many, many months, I've basically stayed short the vast majority of financial stocks in a couple of my services, whereas I've gone long some of the companies that are in non-economically sensitive sectors, that have high Weiss ratings, that have nice dividend yields and so on, because they offer both safety and yield in a lower negative rate world. And sure enough, if you look at the new highs list, in a column I was working on this week, all you have to do to figure out how messed up this market is to put up a chart of the XLP, which is the consumer staples ETF, against the XLF, which is the financial ETF. What do you see in the XLF? A series of lower highs, lower lows. The most recent vigorous rally for the broad market, the XLF didn't even get to its 2016 highs, much less its 2015 highs, whereas the XLP just kept on chugging to an all-time high. XLU, the utility select sector, same thing. It's been on a very powerful move higher, even though in the last couple of days it started to take a pause. And what does that tell you? That tells you that investors, because of all this free central bank money, aren't buying the same stuff they did during the expansionary phase of the credit and economic cycle. They're buying the stuff that's appropriate for the weakening phase of the economic credit cycle. And if they're going to get free money, they're going to use it, but they're not going to use it for risky stocks. And at this point in the credit cycle, they're going to buy the safe stuff. So yet another example of how stupid central bank policy is backfiring. But hey, if that's what they're going to do, I'm going to find a way to profit from it, and our investors should too. So that's what I'm doing in the stock market. When it comes to other related markets, you guys know I've been bullish on the yen since the start of the year, and that's probably been pretty much of a home run trade in terms of currencies don't move all that much, especially unleveraged yen ETFs like I've been long since January. But boy, has that thing rocketed higher. We're finally getting to some levels where, we might run out of a little bit of gas on this move in the short term. But as carry trades unwind, as bonds continue to rally in price, fall in yield, as more and more central bank experimentation fails, all of it points to the rationale for this trade eventually to continue to move in our favor. And to me, it's not just the yen; it's the Swiss franc has been a nice mover in recent weeks, and that's close to some key levels and so on. So steady as she goes in the trades and the positioning that I've been advocating for months. I've got no reason to change now.
All right, thanks, Mike. Appreciate it.
Thank you.
And speaking of currencies, Bloomberg reported this morning that hedge funds are abandoning the buck in record numbers. In fact, speculators cut their net bullish positions on the dollar to the lowest in 2 years. So, Boris Schlossberg, what does that tell you? Or is the bull market pretty much over in the dollar, do you think?
No, it means it's probably just about ready to start. It's usually a great contrarian indicator. Yen short term is interesting because we've had 4 straight days where it held the 108 level. So there may be just in a very short term some semblance of stability here for dollar yen. We could probably see it rally to 110 over the near term. Other than that, currencies remain sort of in a wait and see mode in really across the board. Euro is hesitating at around the 114 level for a very long time. It's really surprising. It's actually been trading 114 for 11 straight days around that barrier. Very unusual for the pair to not move 100 points one way or the other for such a long time. Just because there really isn't any type of economic catalyst that we're looking for in front of us, it looks to be like the Fed at this point is probably going to remain stationary in June. So that is going to be still ultimately dollar negative, given the fact that it's unlikely they're going to increase yields. But so much of this is already factored into the market. The currency market is incredibly forward casting. So by the time I think that the broad story comes across the wires, almost all the trade is done. The other thing that's sort of interesting that I'm seeing in the currency market, just from a technical point of view, I started to see this in the last couple of days. The British pound, which has been under enormous amount of pressure because of Brexit fears, because of fears that UK is going to spin out of the Eurozone and actually leave the Eurozone, appears to be building a little bit of a base here. It may be a situation where some smart money is starting to take a bet that when push comes to shove, the Brits are not going to abandon the European Union and basically threaten their own economic future by doing so. So that seems to be an interesting, contrarian play that's just is shaping up. It's still obviously a little too early to tell, but the consensus view so far is that leave stay vote is very much up for grabs. But it feels like, and I've seen this a lot of times in the currency market, which is why I pay so much attention to it, that when the smart money starts to position on the other side, it tends to, I think, anticipate that the Brexit vote may actually be a bust and that the UK will actually stay, at which point that will be pound positive, and we could see it go up to maybe even 150 as a relief rally happens.
Interesting. We'll definitely keep an eye on that as that vote approaches. Thank you. Let's see, Kathy Lean, let's go to you for your views on currencies and other markets.
Well, we actually laid on a short U.S. dollar trade yesterday, and we're already beginning to see, particularly a move against lower against the Aussie, the Kiwi. I think, first and foremost, Mike talked about the financial sector weakness. Nomura just announced that they're firing another 1,000 people as they kind of quit the European equity business. I think financials in general are suffering. I think this quarter could be one of the toughest quarters for earnings here in the U.S. Since 2009. I think that what you're seeing, not only Nomura, but we're also seeing other companies announce layoffs around this cycle. And that could translate into some softness in non-farm payrolls going forward. One of the main reasons why the buck has been really on the back foot is because no one sees a possibility of a Fed hike this year. Even the Fed officials have been pretty consistent in their message that they're looking to raise interest rates two times this year. And I think the real key is always going to be jobs. And we're seeing the initial flash indications of some weakness in the global labor market. And if we don't see any type of blockbuster jobs reports for the April jobs report, for the May jobs report, they're not going to be able to pull the trigger in June. They may need to notch that 2 forecast to 1 or 0. So that's why we think, there's probably some additional downside in the U.S. dollar, because we think all of this is indicating to us that the U.S. economy is still in trouble. And the nice relief that we had from low oil prices is beginning to fade. Consumer gas price expectations have increased, I think, of 7%. And so that could affect, summer plans. That could make some of the free-flowing spending, even though it hasn't translated into positive spending, start to fade even more. So I think the U.S. economy is not out of the woods. I think that there's still going to be a more adjustment, and that's why we've sold dollars in anticipation of another leg lower. And then in terms of the Brexit, Boris was talking about how eventually the Brits may actually get some sort of sanity into their heads and realize the consequences of leaving the European Union far exceed the benefits, and actually vote to stay. But from now to June is a long road. There's still going to be a lot of positive, negative headlines. There's still going to be a lot of uncertainty. Sterling is a very volatile currency. It'll go up and down 300-400 points and still remain stuck in its range. So even though he probably rightly believes that they're going to vote eventually to stay, we still were positioned for a sterling weakness because we think that there's still going to be a lot of uncertainty, and uncertainty is never good for the currency. I think it's a recent polls show that 1 out of 3 Britons are still undecided with regards to whether they want to leave or stay in the European Union. And this kind of reminds us of the Dutch vote that is happening, and that the low turnout for the UK could actually be quite of a negative thing, because if there's a belief that there's going to be a low turnout, then the most passionate voters are going to come out to vote, and that's going to be the Leave campaign. So there is a risk. At the end of the day, I do believe they're going to stay as well, but I think that the market is underpricing the uncertainty that will happen from now until then.
So it could be a lot of volatility in currency markets between now and then.
Yeah. Absolutely. And I sort of wanted to just reaffirm that the bounces that I'm talking about are effectively dead cat, bounces in the dollar, are effectively dead cat bounces into which you clearly want to establish more short positions. So, my perspective is always ultra short term. Kathy's is a much longer term perspective. So that's why I just didn't want to have any misunderstanding. I'm not bullish dollars long term, but I'm just bullish dollars for a dead cat bounce maybe for the next day or two when you're looking at prices, but that's about it.
Okay, thanks, Boris. Thanks, Kathy. Let's see, David Dukevich. We've seen gold, precious metals continue their winning ways very strong, with gold up to around $1,265 an ounce. What do you think? Is it going to just keep moving higher here?
Hey, Mike. Hey, everyone. It certainly could. There's some levels gold still needs to get through to really confirm that we'll have another significant move higher. And that right now we're kind of starting to run into resistance around that 2060 level. We're a little bit above that now, but we really need to get back to a new short-term high, which was getting back above the 1287.80 level. So that's going to be key to watch for gold. If we can get up through there, then we should be able to push to 1300 and maybe get up to 1315 even, or possibly 1375 even as we really move later into the year. Right now, if we don't get through that level, though, I still expect us to pull back a bit. So I'm still looking for a pullback possibly to the 1200, 1188 range. But again, that's really a precursor depending on if we can't get through the resistance where we're kind of running into right now. If we do see the dollar strengthen a bit short term here, which Boris mentioned earlier, that probably means we could see that gold pull back a bit, getting ready for another move higher. Silver, on the other hand, has actually broken out of its recent range this morning, getting above that $16 level. It's trading at about $16.15 right now on the May contracts. So that's looking. We have to see if that can continue or not, or if this is just going to be a quick breakout and then pull right back into the range again. So those are getting to both silver and gold that really getting to a point that we need to watch here, because if we do break through and significantly break through, we could get a pretty significant moving higher here. When it comes to some of the other commodities, oil had already made its pullback, got down into that $35, $36 range, held that. Now it's moved back above 40. So that's looking a little bit stronger right now at this point. So I do think we could push a few dollars higher here into maybe the $43 level. If we can get through that, maybe we'll get to $45, $46 level, at least in the near term. Natural gas as well pulled back, got down to about $1.90, held there, trading back up to about $1.95, $1.96 right now. I would, in near term, think we should be able to break that $2 mark, get to about $2.10, $2.15, and then maybe even get up to $2.25, at least in the short term. The grain markets have also pulled back. They're starting to firm up again here. We'll have to see if they can continue to hold their levels, and if they do, they might be a buy getting closer to the bottom part of these where they're trading right now. Particularly corn pulled back the most, so we'll see if that can hold up as well. When it comes to the equity markets, we've seen volatility finally start to pick up a little bit here over the last week, and I do expect to probably see that continue. Last week we saw up, down in the markets. Every day was different. We even saw pretty big intraday moves as well. So I do expect to see that type of trading action continue, where the S&P is going to have trouble kind of getting through that 2065, 2085 resistance level. But on the downside, we'll have to see support coming in around 2015 to the 2000 level. I expect to see is probably in that range. If we break below that 2015, 2000 level, I do expect to probably go back and test about 1950 on a pullback.
All right, thanks, David. Mandeep Rai, let's get your take on the state of the markets here as earnings season gets underway.
Sure. Hey, good morning, Mike. Good morning, everybody. So the expectations have been ratcheted down further even since last week. We're now looking for a 9.1% decline for the first quarter in terms of earnings in the S&P 500. So we're, it's parallel with the declines, consecutive quarter-over-quarter, 4 quarters of declines in the depths of the Great Recession. So the bar is very, very low at this point. So we'll probably get a higher beat rate, but it'll be interesting to see if that, if the beat versus the absolute decline, the magnitude of that decline will impact the markets, or excuse me, or if we'll get another pass. And I think the catalyst for a pass would be if the guidance or the outlook was to be pretty good from the C-suite of some of these large cap companies, and that could happen given that we've got some relief in the dollar a little bit there, and a little bit on the oils and the commodity side. But the market's in a sideways chop, and it's been there for the last 11 months or so, and it's not really breaking out to a new high. It's kind of a little bit worrisome given that we're at a little bit of a heightened valuation. So even though price is staying constant, with earnings declining, that's making the market more and more expensive. And if we continue to chop sideways, we're kind of ignoring the fundamentals. We're getting pricier and a bit more susceptible to volatility. One can augur that the market is kind of to try to price in forward expectations in terms of the improvement in oil prices, slightly better data from the from the rest of the world, stabilization of the dollar, and so forth. But growth and inflation have been pretty benign globally, and that's pretty nicely here in the U.S. We're looking at first quarter GDP around 0.6%, after being as high as 2.3% for expectations. We have the same culprits here. Manufacturing data is bad. Inventories, retail sales, things like that aren't as good as could be, and that's causing a clampdown on expectations. So I don't know what the immediate catalyst is going to be to wake this market up from what seems to be a bit of a slumber. But you can't ignore how susceptible we could be to something coming out of the blue, like a black swan event or something like that. You can't, there's uneasiness in the rest of the world. We have OPEC meeting next week, at the end of this week, with non-OPEC producers, and there's going to be a lot of rhetoric going around, into that, and oil's going to rally a little bit going into it. We'll see what transpires, if they do get the the production freeze or not. It'll be interesting to see how that plans out. And it was good to hear about the Brexit risks. Excuse me. And I was reading an interesting article from the Wall Street Journal about the banks in England using Britain as a sort of a trampoline to be able to access the rest of Europe without all the regulation and so forth. And they're lobbying for England and the greater United Kingdom to stay within the Eurozone. But we'll see how that plays out as well. That could be a significant risk to the downside there too. And nobody really knows what how fast the impacts will happen and what the exact impacts are. But that could be another thing that could steer these markets into pricing in risk off. If I had to pick something that concerned me the most, it would be the consumer here in the U.S. and the inability of banks to find qualified and willing borrowers despite rates being so low. And consumers are still kind of reeling in the wake of the great deleveraging since 2008, 2009. They've been selective in spending their extra gas money. We'll get retail sales numbers tomorrow, but the consumer is very important to our economy. It's about 2/3 of the GDP. But given that we have election cycle that's coming, the rhetoric that's going on that front, what's going on in terms of global growth, that's uncertainty, and that kind of pressures confidence. And we'll be looking to see what the pulse of that consumer is going to be like. And in terms of the overall market, Mike's already mentioned, the defensives are leading. We have, utilities are up there, the telecoms are up there. Financials are lagging, and we're also seeing an asymmetric pricing of options for the S&P 500. Interesting data from Credit Suisse suggests that the prices for puts are much higher than those of the same term and calls. You have to go further down in terms of strikes to get the equivalent pricing for calls, which is interesting because it tells you that market participants are buying protection. They're positioning against a pullback in the next 3 months or so. So each day you see this market rally, and it kind of starts off strong in the morning, and after Europe closes, we start to see a fade. The uncertainty is there; it's undoubtable. And even if we flirt with highs again, I'd stay cautious. There's numerous upcoming events that could cause this market to stop looking so far out in the future and start pricing in more immediate risks. And the longer we bounce around aimlessly, I think historically that augurs that we potentially could see some downside. So that's how I'm playing it on the cautious side.
All right, Mandeep. Thanks for the update. Appreciate it.
You got it.
Well, that wraps things up for this week's Squawk Call. Great insights, ladies and gentlemen. Thank you. And be sure to tune in again next week. Until then, I'm Mike Bernick from Money and Markets. Good investing.